Welcome to Verney Tax Law. This is the first part of a series on offshore disclosures. This particular segment will deal with an overview of the Report of Foreign Bank and Financial Accounts, commonly known as the FBAR. In the past, many people who maintain financial accounts in foreign countries failed to report these accounts. In response to the problem, in 1970, as part of the Bank Secrecy Act, Congress passed legislation requiring certain U.S. taxpayers to report their foreign accounts by filing Form TDF 90-22.1. The form that is used today is called FinCEN Form 114. The legislation also required that the affected U.S. taxpayers maintain records of their accounts. Finally, the legislation provided that the willful failure to comply with either of these requirements could lead to the imposition of civil and criminal penalties. Despite the legislation, very few taxpayers complied with the law. So what changed? Well, late in 2004, as part of the American Jobs Creation Act, the law was amended and for the first time introduced new penalties for the non-willful FBAR violations, and further more stringent penalties for willful violations. While the FBAR penalties are authorized under Title 31 rather than Title 26, the Secretary of the Treasury and in turn the Internal Revenue Service have been tasked with investigating FBAR violations and assessing penalties. Specifically, the IRS is empowered to investigate potential civil and criminal violations, issue summonses as necessary, assess and collect civil penalties, issue administrative rulings, and take any other action reasonably necessary for the enforcement of the FBAR-related provisions. So who must file an FBAR? Under Title 31, Section 5314 and its regulations, a U.S. person who had a financial interest in or signatory authority over or other authority over one or more financial accounts located in a foreign country and where the aggregate value of such accounts exceeded $10,000 at any time during the calendar year must file an FBAR. Under the old law, the Secretary had the burden of proving by clear and convincing evidence that the taxpayer acted willfully. Meeting this burden required the Secretary to demonstrate that the taxpayer knew about the two FBAR-related duties, yet intentionally ignored them. Carrying this burden also required negating a defendant's claim of ignorance of the law or a claim that because of a misunderstanding of the law, he had a good faith belief that he was not violating any of the provisions of the tax law. Under the new law, the IRS is authorized and may impose a penalty on any person who is required but fails to file an FBAR or who fails to retain the necessary records concerning foreign financial accounts. In the case of a non-willful violation, the IRS may impose a maximum penalty of $10,000, except in cases where the taxpayer can establish that the violation was due to reasonable cause and the amount of the transaction or the balance in the account at the time of the transaction was properly recorded. With respect to willful violations involving a transaction, the IRS may impose a penalty of $100,000 or 50% of the amount of the transaction, whichever is greater. Unlike the non-willful FBAR penalty, the reasonable cause exception does not apply to willful FBAR violations. The 2004 amendments are significant in the following respects. First, they establish a penalty for non-willful violations of the FBAR statutes. Second, there is a shift in the burden of proof from clear and convincing evidence to a preponderance of evidence, a much lower standard. Also, in the non-willful FBAR context, the burden is shifted to the taxpayer to meet the reasonable cause exception. Third, the new law increases the maximum penalty for willful violations. In order for the government to prevail with respect to an FBAR assessment, they must prove by a preponderance of evidence, one, that the taxpayer was either a citizen, a resident or a person doing business in the United States during the relevant tax period. 2, that the taxpayer had a financial interest in or signatory authority over a financial account located in a foreign country. 3, that the foreign financial accounts had a balance that exceeded $10,000 during the relevant tax years. 4, that the taxpayer failed to report these financial accounts. 5, the amount of the penalty was proper. Additionally, in the case of a willful FBAR violation, the government is tasked with proving that the violation was willful. We will take up the question of willfulness in the next segment, as well as changes in the level of proof required to sustain the FBAR penalty. Thank you for listening.